Hey guys, welcome to the channel. In this video, I'm going to explain how you can improve your trading results by analyzing the market in a higher time frame, even if you execute your trades in a lower time frame, like I do. If you are constantly opening trades in the wrong zones, then this is the perfect video for you. I'm going to share some ideas on how you can get better at selecting your entry levels and avoid trading in the wrong places, just by zooming out and looking at the bigger picture. If today's episode brings you value, don't forget to give it a thumbs up and subscribe to the channel. It really makes a huge difference. Before I start, let me just ask you, how do you usually look at the chart? Do you look at the charts like this, option A, just looking at the most recent price? Or do you also look at the charts like this, option B, where you can see the bigger picture of where price is? Let me know your answer with an A or B in the comments below. As I mentioned before, I don't open trades based only on the higher time frame. Anytime I'm looking for a setup, I always wait for price action confirmation on the lower time frame before I execute my trades. However, I noticed a big improvement in my trading when I started to include higher time frame analysis in my trading routine, which I do during the weekend while the market is closed, in order to prepare for the week ahead. So here are some of the advantages of doing higher time frame analysis. Knowing where price is in the bigger picture. This helps me to be in control and gain more perspective in order to make better decisions during the week, while I look for setups in the lower time frame. Secondly, to filter the pairs for the next week, by selecting the pairs that are in place to give me the best opportunities. What I do is I set up the alerts around my zones of interest, so I'm aware when price is getting close. Besides that, I also like to predict the price action that I want to see on approach before executing my trades. By the way, this is a great exercise if you want to improve how to read price action. For example, let's pretend that you are looking for sales inside this area, and price at the moment is somewhere in here. So what price action would you like to see happening before you open the trade? If by any chance you will just be placing a pending order in here, maybe with your stop loss above the zone, you don't really care about price action. However, if you'd like to see some kind of confirmation before placing your orders, you should know what type of PA you would like to happen in order to execute the trade. Maybe you would like to see price slowing down during the approach, creating some kind of compression on the way to the zone. Or you would even like to see some kind of confirmation to the downside by breaking these lows before even entering your trade. Here are a few examples of how I do it, either in the higher time frame predicting the overall move, like I did in this example on this daily chart on dollar index, or in the lower time frame in order to execute my trades, like I did in here. Usually, I create 2-3 scenarios of what price could do, and I keep adjusting my predictions as price evolves. Try to be super specific while we do it, it's important. I couldn't recommend you enough to start doing this exercise. The last two advantages are the ones I will explain in more detail during this video, and they are selecting better entry zones and avoid trading in wrong places. This was actually one of my biggest mistakes. And finally, learn how to manage your trade expectations. When should you be more conservative or aggressive with your targets? By the way, let me know in the comments what other benefits would you include in this list. So, how looking at the bigger picture help us getting better at selecting our entry zones and avoid trading in wrong places. Let me give you a few examples from my personal experience. So, I'm naturally a counter trend trader. By the way, if you want to know what type of trader you are, just look at one chart that is moving strongly in one direction and check what kind of setups do you naturally look for. Do you look for ways to enter in favor of the move, or are you looking for ways to catch the reversal? Depending on your answer, you'll know what kind of trader you are. For example, we have this Euro-Aussie dollar here, and we can see that price is moving to the downside. Where would you be looking for trades? Would you be looking for a retrace, then price to carry on to the downside? Or would you be looking instead for price to start creating some kind of price action to look for a possible reverse to the upside? Your natural instinct will tell you what kind of setups you'll be looking for. And that's the kind of trader you are. In my case, I'll be looking for a place to see where price could reverse to the upside. And this is exactly one of the situations that knowing where price is in a higher time frame can help you to avoid entering trades in the wrong zone. In the past, I was easily getting caught in losing streaks just trying to catch the reversal in the market when price was in the middle of nowhere. And with that, I would get frustrated and start forcing trades that was naturally affecting my performance in a negative way. After going through this situation so many times, I started to look for ways to avoid trading in those levels. I noticed that when I looked at the bigger picture, I was trying to look for reversals when price was far from being at an important level of structure. It's like trying to get the tram in the middle of the road instead of waiting for it by the tram stop. It doesn't make sense, right? That's exactly what I was doing. Let me show you what I mean. Let's pretend that price is in between these two levels of structure. These two. Price came all the way down, starts compressing a little bit, and now reacts to this level of structure. Now price reverses and starts going to the upside, takes it, and now price is here. Okay? So in here, there are two moments that I want to talk about. I want to talk about this movement in here, and I want to talk about how price can fill all this space until the next level of structure. So in this first zone is where I used to make my mistakes, trying to look for reversals when price is in the middle of nowhere. So if you take a look at what you have in here, basically you can see that this is a compression. Basically these highs are already taking the orders from the previous highs. And this high is the last level of structure that should be holding price down before price indicates that wants to go higher. After we have that break in here, we have the indication that price wants to go to the other extreme, to this level of structure. Now, price doesn't need to go straight away there. Actually, what usually happens is after the last break of this high, what we see is price correcting the stop losses that were above this high and retracing. Now, we either have a deep retrace up until the origin or just a small retrace until then price continues to the upside. And when we have the second break of this high, basically that's the confirmation that price is ready to go to the upside. And that's what happens in here. This is usually when we see price gaining momentum and starting creating strong bullish candles. And when this happens, it's no longer a good moment to look for sells. Now this looks quite simple to understand if you are looking at this picture. However, the problem is that let's pretend that this is a daily time frame. And in here, let's pretend that all this movement is a daily candle. If I draw the daily candle in here on the side, let's pretend this is what I have in there. And let's pretend it is a daily time frame and this is a strong bullish candle. However, if you take a look at it in the hour time frame, let's say 1 hour and lower, the chart will look different. Maybe something like this. So this is what we could see maybe on the 15 or 5 minutes chart inside this strong bullish candle on the daily chart. Let's pretend that the price would go up, I'll go to the downside, fake out these lows and start to move to the upside. Goes up, creating small highs but being broken until we get to the end of the day and maybe price just retraces a little bit and eventually closes in here. Usually this movement that we can see in here, this fake out, it happens around the London Open. Then price carry on going to the upside and maybe this strong move happened when the US session opens as well, confirming the move to the upside, and then price just goes up in this way, and then at the end of the day price loses a little bit of the momentum and retraces a little bit. So this is still a strong bullish candle on the daily time frame, but as you can see on the hour time frame it looks a little bit different. And my problem was that I was looking for sales when price was retesting these highs. It looks stupid when you see it like that. However, if you take a look at this high in the 5-minute chart, it may look something different. It may look something like this. And in here, there is maybe opportunity to look for sales. It may look like that it's an important resistance level. Sometimes this will even break something here on the left side. That's when the confusion kicks in. And you start getting upset anytime you start seeing all these highs being broken. And this happens mostly if you are just paying attention to the most recent price action. And it is exactly in these kind of scenarios where zooming out and looking at the bigger picture, exactly like we have in here, that can help us to avoid entering trades in the wrong spots. By zooming out or going into the higher time frame, the main goal is to see where price is reacting to on the left side of the chart. because this is what is going to help us to understand if we are in a good level of structure or not, or if there is still space until the next level of structure. And being aware of that, I decided to force myself to be patient and wait for price to get to my zone of interest, or at least to start showing some signals of weakness, before even thinking about looking for a reversal. Signals of weakness could be to see price compressing, or even breaking structure on the opposite direction. In this case, it will be to start breaking these lows. This will mean that the sellers would start jumping into the market as well, fighting for price, and eventually winning some of those battles around these lows. Now, as you can imagine, this is easier said than done, because the days I'm talking about is when price is moving just in one direction since the open of the London session until the end of the day. As I said in this example here, usually this fake out happens during the open of the London session. And if you look at the charts during all day long, you tend to be tempted to look for trades, even when you shouldn't. So you really need to be disciplined and have self-control. My suggestion, it would be for you to set up alerts and go be productive doing something else if the market is not close to your zones of interest. By the way, at the end of the video, I'm going to share with you a counter-trend strategy that I started to implement in those exact days, which is to catch this movement in here that happens at the end of the day. Now, the examples I've mentioned until now have been for reversal setups. However, being aware where price is in a higher time frame, it's also important if you are a trend continuation trader. I often see examples of traders that just pay attention to the most recent price action, and when they see structure being broken, imagine that price was going high, it retraces, and now it creates a new higher high. After this higher high is created, they'll carry on with the bullish bias and looking for longs. However, if you zoomed out and look left to see where price is reacting to, maybe you could see that price is just reacting from an important level of structure. Exactly like we can see in this example. And the move to the upside in this case has been completed for now, and price is actually ready to reverse, which means that looking for longs in this moment, it's not exactly the best thing to do. Because price now, after reacting from there, is going to start going to the downside and eventually is going to stop you out. So always be aware of where price is reacting to on the left side, either if you are looking for counter trend setups or trend continuation setups. In this case, if you want to look for trend continuation setups, look for them during all this period, around here. When price just broke this structure, when you have all this space until price gets to the next level of structure. I hope by now you have realized the importance of looking at the bigger picture, instead of just looking at the most recent price action. Let's continue. Let me just delete some of this stuff now. Now the second moment that I want to talk about is how price can fill this space until we get to the next level of structure, in here. This is basically what I mentioned before when I talked about what kind of approach you would like to see price doing towards the zone. Kind of compression, or you actually want to see price breaking opposite levels of structure as confirmation. The reason I want to talk about this moment is because it's when price is approaching these levels that price action starts to be tricky, and the manipulation starts to happen with price breaking highs and lows and then reversing without having a clear direction. And it's easy to get caught in the wrong side during these moments, because at this point you don't have a clear direction where price wants to go. For example, if you just look at the price inside here, where do you think that price wants to go next? You think that price wants to go to the upside, or that price wants to go to the downside? It's not that clear, right? However, if you zoom out, you could get some clarity of where price is in the bigger picture, and anticipate all these movements by making your predictions in advance. Avoid getting caught during these manipulations, it's not easy. It requires to be patient in order to wait for the A+ setups instead of chasing the B or C setups. If we take a look at our example, we can see in the bigger picture that we are approaching an important level of resistance, which means that most likely price is creating all these erratic moves in order to attract as much liquidity as possible into the level where they want price to reverse. So most likely they will start creating some fake highs in order to get the stop losses from all these traders that want to sell at this level of structure. The way they do it is to attract as much stop losses as possible into that level. And how they do it is by creating fake structure just underneath it. And this is usually what you can see. Spike and price reverses. Now let's take a look at the last advantage that I want to cover in this video. How to manage your trade expectations by looking at a higher time frame. To find out, we need to know the answer of the second question. Where is price coming from? This is part of the process I follow anytime I'm doing my analysis. I always try to answer these three questions. Where is price coming from? Where does price want to go? Where is price at the moment? You can check on my previous video how I answer these questions. It's important to understand because all the answers are connected to each other. Just a parenthesis, if you haven't noticed, the answer to the third question is the solution to the previous point. Knowing where price is at the moment, in the bigger picture, will help us to avoid opening trades in the wrong zones. Let's continue. So, by answering the second question, we basically want to find out where is the next target for price and if there's still space until there. And if we have space, then we know that price wants to move in that direction. When we do our analysis in the higher time frame and we find lower time frame setups that are aligned with the bigger view, we may have found a great trading opportunity, and in this case it makes sense to be more aggressive with the final target. What I mean is to extend it until the higher time frame target or somewhere close to that level. So let's take a look at this example on the dollar index. As you can see, this was a prediction I made at the end of August. What I could see is that this high had just been broken by this high, and after that price decided to retrace. However, in my opinion, where this high reacted from on the left side, somewhere in here, it was not the final target. Because I could see that this high is the origin of this last move to the downside, and the origin inside here was still fresh. Because none of these highs went there to collect the orders from the origin, which means that it's still fresh. Anytime you see me doing this kind of drawings on my charts, it means that there were some orders left behind, and price hasn't collected them yet. That's why you can see this in here and in here. This is another example. This low and this one, it never collect the orders from this origin, which happened later on. Same in here. Price didn't go there, left the orders behind, and then eventually price collected them in the future. So what we know by now is that price had engulfed to the upside, giving indication that wanted to go higher in the future by breaking this high. And we also know that the final target hasn't been reached yet, somewhere inside here. So what you can do now is try to find setups to enter long. And if we manage to find that setup, then we should be looking for an aggressive target. Instead of looking for our final target at the next opposite structure, for example inside here, around these highs, we have already price action confirmation that price wants to go to the upside, at least up until here. Now in this case, we know where the target is and we know that we still have space. And that's why I made this prediction. And this is exactly what happened, as you can see in this example. When I made my prediction, price was around here, and as you can see, price had just reached its target. And as you can imagine, the opposite is also true. If you know that price wants to go higher, and if you find a setup to sell, don't expect a home run kind of a trade. Your target should be the next level of opposite structure. And that's it. Otherwise, you'll find yourself constantly leaving money on the table, which is something that also affects your performance in the end of the day. Do your own due diligence, track your target percentages, and decide what's best for you. I'm just sharing a common problem that I struggled before, and I still see many traders having big expectations anytime they open a trade, by placing their targets in levels that there was no price action that would suggest that price wanted to go there. For example, if you're looking for sales inside this high, you could see that price still reacted from there, because there were still orders in there. However, it didn't go anywhere else besides retesting previous support and resistance. This decision point inside here. And then it carried on to the upside. So by being aware of the higher time frame analysis that we just did, I knew that if I was looking for sales inside here, I wouldn't be expecting too much from it. Especially because this low also respected this level of structure, which means that we didn't have any engulf to the downside. And this is how you start connecting all the dots. Let me know in the comments below if you use multi-time frames to analyze the market and execute your trades, or you just do all of it based on one time frame. Also, give me your feedback if you found any value on the points that I just shared with you. Now let me share with you the strategy that I started to implement in those days when the market is moving in a strong move during all day. For example, let's say that the market is aligned and the dollar index is going down, which means that euro dollar, pound, Aussie, and so on have been in a strong bullish move during the day. As the day is coming to the end, after the London close, Something that happens sometimes is to see some of those pairs slowing down and eventually retracing a little bit. And it is exactly when this retrace happens that I try to look for a setup, trying to catch more or less a 20 pips move. The reality is that I come up with this idea because of the frustration of observing price going up non-stop during all day, with the mental battle of not being able to participate in the move and having to stay on the sidelines, until I started to notice those retraces at the end of the day. One of the reasons for the retrace could be, for example, the traders that are closing on their own winners for the day. And what usually happens is price retracing and pausing during the close of the US and the Asian session, with the move resuming to the upside the next day around the London Open. You can also take a look at the daily charts and notice when you have strong moves, you can see that it's not that often that price closes exactly at the same level of the higher high or lower low that is created for the day. Usually there's a difference between those two zones. You can also investigate it in the lower time frame. What I mean is this spacing here, between the higher high and the close of the day. To trade this setup, don't forget, of course, you still need to be aware of everything I said before. Be aware of where price is in a higher time frame. Manage your expectations on your trades. For example, knowing that in this setup, I'm just after a 20 pips move and not a big reversal. And of course, to see if we have any price action around this level in order to take the trades. In fact, this is an example of how you can implement new strategies in your trading portfolio. Even though this is not an A+ setup for me, I managed to identify a pattern that happens in a specific moment of the market, and everything I had to do was to find ways to make it profitable for me. I basically went from making a mistake that was costing me money, to avoid making that mistake by stopping opening trades in the wrong places, to identify a pattern that actually works for me. And this is something that you can also do. After spending so many hours looking at the market, you should be taking notes of the patterns that you start noticing, and maybe there's a strategy that you can implement and add it to your trading portfolio. Now, let me review what I covered in this episode. How looking at a higher time frame can improve your trading results. First, as preparation for the week ahead, you can filter the pairs that will provide you with the best setups, and set up alerts so you don't miss the trades. Secondly, to avoid trading in the wrong zones. For that, you need to answer the third question. Where is price at the moment? Zoom out and look left to answer the question. And third, it helps to manage your trade expectations. For that, you need to answer the third question. Where does price want to go? Find out where is the next target and if there's still space to be filled. And that's it, guys. I will just leave you with a few recommendations that I believe it will help you to become a better trader. First, create a habit of asking questions when you are looking at the market. Gather as much information as possible when you are looking for the answers. Zoom out and look left to gain perspective of where the market is. It will help you being more in control and less reactive. Besides that, practice drawing the price section that you would like to see happening in order to execute your trades. You'll see a big improvement in your analysis. And last, since I have mentioned a few times in these episodes the importance of knowing what type of trader you are, my recommendation for you is to take the time to identify your strengths and your weaknesses. Make a list of the things that you are struggling at on your trading. For example, it could be opening trades in the wrong spot, maybe forcing trades that you know that you shouldn't trade, or revenge trading after losing a trade, or even fear of opening a trade. Just to give a few ideas. After making that list, find a solution for it. Don't just say that it's because of your psychology or mindset. Go deeper than that and find a solution and implement it in your trading plan. My advice would be for you to double down on your strengths and find ways to remove your weaknesses from your trading plan. For example, the solution I found was to implement a rule to stop looking for reversals that were not reacting from an important level of structure. And what happens after that is that your mind goes from the state of fear and anger to a state of calm and creativity. And instead of just playing on defense, you actually start looking for positive solutions on how you can profit from this type of situations. If you got any value from this video, don't forget to like and subscribe to the channel. In the next videos, I will explain how to read price action in a naked chart. And if you know anyone that would benefit from watching this episode, please share with them. Thank you for watching, guys. See you next time. Obrigado.